So let's turn a little bit to investing. You reference a pretty fascinating paper, an academic paper in your book, Selling Fast and Buying Slow, where the co-authors, they looked at 783 institutional portfolios. The average value was about $570 million. So it's probably, enough to actually add value. What I found surprising is they were actually successful at buying stocks that generated excess returns. Then they lost most of it, if not all of it, when they sold. Why was selling, or why is selling so difficult, even for professionals?
Yeah, so okay, so let me set the stage. So look, this book that I wrote is about why quitting is really hard for us to do. Like that we're bad at it, even though it's an incredibly important option to have in your hand, right? So you make a decision, you find out new stuff after the fact. The option to quit is what lets you react to that. So you can get out of it. But then we're actually really bad at exercising that option. So on the retail trader side, when they have these stop losses, they actually cancel them and let it ride. So that's a particular mistake with quitting that non-institutional investors will make, just like everyday people. And it's because like, but if I sell now, I can't get my money back. That's sort of in a nutshell what's going on there. Institutional investors do not make that mistake. Okay, so they don't just like keep the losers riding. Instead, what happens is, on the buy side, they're doing 120 bips better than the market. On the sell side, they're doing about 70 bips worse than a benchmark. And the benchmark that Alex Imus set up, which I think is amazing, is what if we threw darts at your portfolio to free that capital up? Right. So that's a good benchmark, right? We just randomly free capital up across a portfolio because the situations that he's specifically looking at are an institutional investor that's fully committed. They now have a new thesis that they want to trade. So what do they have to do? They have to go free capital up from their existing portfolio in order to be able to trade this new thing. So that's the question that we're asking. Um, so obviously 70 bips worse than the market is terrible, particularly for people who are clearly really good investors. We know that from their buy side behavior. So when he looked into it, what he found was that the investors were using a heuristic, which was to only look at the extremes, the tails. So when they freed up the capital, they would be freeing it up from either the extreme winners or the extreme losers in the portfolio that they were currently holding. In other words, they weren't looking at the whole portfolio to think about something like expected value, like what's the lowest expected value thing that I have sitting in my portfolio, which may be, the thing that hasn't moved at all in a really long time, for example, right? That's just like super low volatility, but it's not really going to make anything. Whatever. They're not looking at anything except for the tails. So, first of all, that's bad, right? So they're using a rule of thumb that isn't actually about uh, what is my best thing going forward, which of course is what they're doing on the buy side, right? When they're choosing to buy, they're doing all sorts of quant analysis and what should I, what's the highest expected value and how much risk can I take on and so on and so forth. And that's actually why they're so good. But on the sell side, they just dump all of that. They're not thinking like, if I were to look at my whole portfolio, what's the one thing I wouldn't buy today? Because that's really the question that you should ask. Like, where's the stuff that I wouldn't buy today? And apply the same rigor to that decision. Instead, they're just going, well, this one's winning a lot or this one's losing a lot. Just that rule of thumb. So then, and then one thing that Alex points out, which I think is so insightful, is that they're using this rule of thumb. And then, unlike on the buy side, there's a feedback problem for them to know that the rule of thumb isn't any good. So when you buy something, you track it. I mean, it's as simple as that. It's in your portfolio. You can see the tick up and tick down every day, right? You're looking at the P&L. But when you buy it, it's done. It's off the books. So it's like nobody's creating, sort of going through the work that Imus went through actually to be able to understand this, which is to say, well, let's compare it to the benchmark over time and actually bothering to create the benchmark and then compare. People aren't doing that because once you sell it, it's gone. And we can only get better by closing those feedback loops, but they're not getting the feedback to be able to close. So they're not even aware that they're losing so much to these sell side decisions. Right. I mean, I think that this really brings up a problem, not just for investors, but for all of us with our quitting decisions, is that when we quit something, we're kind of left with a vague counterfactual, right? Like of wondering, what if I had married the one that got away, right? Like, what if I had done this other, thing that we have abandoned? And that's just sort of stories we're telling in our head. And that brings up the shame of what's happening with the institutional investors, because unlike us who have to make up the stories because there's no way for us to know, we can't live the alternative universe, they actually have a way to explore the alternative universe, but they're not doing it.
Right, and we should. We should. And I wonder if it seems like maybe retail investors are better at doing that because, like, like I sold an ETF PFIX a month or so ago, and this was a ETF that protects against rising interest rates. So it done very well. It's up 35%, and then I sold it, and it's not, it's 0.2% of my net worth, but it still feels bad because interest rates continue to go up, and so you still have that emotion. So I wonder if retail investors tend to remember having sold something that they didn't want or that didn't work out.
Well, my hope is that they don't remember that. Because again, that's sort of like the one example, right? Right. Then, then you get into like, we should all be like Steve Jobs because Steve Jobs was successful. So we should all be exactly that kind of leader, right? But that's just survivorship bias. Here's the tendency that we have. We have a twofold problem with buying and selling, with quitting, with sticking. Um, we really like to sell things when we're in the gains. So when we have a gain on paper, we want to sell it. There's sort of a pattern to, these quitting and sticking decisions and where we get them wrong. So it's essentially this. We love to quit when we're in the gains and we hate to sell when we're in the losses. So just simply put, if you have a stock that's trading, $10 higher than you bought it at, you're going to have a tendency to want to sell it because you want to take those gains that are on paper and you want to turn them into realized gains. You can kind of think about it this way: as long as I hold it, then I could lose the money that I've won. And I don't want to do that. So we want to take the sure win. And the only time that the win is sure is after we quit, right? We have to sell it in order to lock it up. So we like to do that. And in fact, when this is other work by Imus, when Emas rather, it's other work by Emas, that he actually looked at retail traders, and what he found was that they were canceling their take gains before they ever reached the benchmark that that the take gain was telling them to sell at. So they buy it at 50, the take gain is 65. At 58, they're done. They're just selling it. Okay, so that's on the one side of the equation. On the other side of the equation is that we don't like to sell things that are in the losses. So why? Well, kind of for the same reason, right? Like the moment that you sell is when you go from on paper to realized. So that's when you're sure. And just as we love to take unrealized gains and turn them into realized gains, we do not like to take unrealized losses and turn them into realized losses. We just do not like that moment. It's called sure loss aversion. This is a concept, an idea that comes from Daniel Kahneman, Nobel laureate. What you see with stop loss orders is the reverse of take gain orders. They also cancel their stop loss orders, but that's to let it ride. They want to keep going with it. Because again, if you bought it at 50 and it's now trading at 40, you haven't really lost the $10 until you sell.
Right. So if I understand this, by sort of zooming out as opposed to being focused on that one position, whether it's a gain or loss, zooming out helps us to sort of, both in investing, look at the portfolio, or even in life. I think in your book, you talk about diversity of skills or talents. And I know this is something that, with Camden and with our kids, when they quit, we say it's okay because you've gotten more inventory that you can use in the future.
So you talked about your portfolio, right? But that's not the way that most people think. Most people think about an individual stock, right? So our mental accounting works such that when we start something, we open up a mental account for it. Okay, so think about this cognitive ledger that we carry around with us, right? And when we're in the losses, we don't want to close that account in the losses. In other words, we don't want to exit in the losses. So, of course, this is silly, right? Because we have limited time, attention, money, so on and so forth. And at any given point in time, we want to be directing those resources into the place that has the highest ROI. So it shouldn't matter if that one account is in the losses, because you assume that there are other things that you could be doing where if you closed it, you'd be able to now move your resources into something that would perform better, right? I mean, that should be like, if you were logical, you would think of it all as fungible, one across the other, and we should be counting across all of the decisions we make or all of the investments we hold or across the whole portfolio, so on and so forth. But it's just not the way that our brains work. We think about things kind of one at a time, and that's not just true for investing. Any time that you're spending, say, training for a marathon is time that you can't spend on other things. If you're in a job, that's time that you can't spend in another job, because you're not two people, you're a finite one person. And if you're in a job that you hate, not switching is costing you a lot, because it's not letting you switch to an opportunity that would be better. In the same sense as if I'm staying in a stock, in an investment that's a losing investment, in the real sense of a losing investing, meaning it's negative expected value, just because I happen to have lost money in it already, that's preventing me from moving that money, maybe that $40, right, into something that is positive expected value. And this is what this quirk of our mental accounting makes us do, is it causes us to be like super sticky in situations where we're in the losses, and probably not sticky enough when we're in the gains. So when our portfolio is down, we aren't thinking very rationally about, well, if I were coming to this decision fresh, is this what my portfolio would look like? Because that's the question that we should be asking ourselves, right? But instead, we come to the portfolio that's down, and we're much more likely to answer that question yes, because we don't want to actually change things around and have to realize some of those losses.